Everyone. Uh, Today's session, although we had planned it 3 weeks ago, we are fortunate to have this session after the GSTN advisory, which came out on 10th December. And in this session, we will also be touching upon those areas of ITC disclosure, which we can discuss at length. And of course, how all the disclosures must happen on a clause-wise basis. Few tips also will be provided along the discussion, and at the end we have few department issues and what solutions we can think of to address the same. As she has mentioned, any questions, queries, clarifications, please do put it in the chat box. My session will be up to 4:30, after which Mahadev will be taking the GSTR 9C session. To 30th November. The most important tables are part 2, part 3, part 4, and part 5. Part 1 and part 6, either they're having auto-populated details or they're having tables which are not mandatory presently. Only 1 or 2 tables may be mandatory in these parts. So coming to part 2, as per our instructions to form GSTR 9, it has been very clearly said that if any transaction has not been shown in GSTR 1 and 3B, it can be shown for the first time in our GSTR 9. This is mainly with respect to 1 and 3B. That means they're specifically talking about outward supply. That is your liability. This also includes your RCM liability. Whether we can show unclaimed credit for the first time in GSTR 9, the answer is no, because credit claim happens only through GSTR 3B. This is very clear intention of the government that if you have any additional liability to pay, you can pay through 9. But if you have missed out any credit, that once it is past the time limit, it cannot be claimed. Recent decisions also have held the time limit constitutionally valid. So I don't think there is any prayer which is possible for claiming credits beyond the due date. So to that effect, what all activities can we do to ensure appropriate claim and disclosures will be discussed in the upcoming slides. In part 4, the details of tax payable and tax paid is provided. Tax paid is an uneditable field. Tax payable can be edited, and to this extent, what we must edit also will be discussed. Next, we have part 5, that is the transactions of the current year disclosed in the next financial year. So when I say current year, I mean the financial year of 23-24, because we are filing the GSTR 9 of 23-24. What transactions, be it RCM, be it outward supply, be it input tax credit, be it reduction of outward supplies, be it ITC reversals, all of them can be disclosed in this table 10 to 13 of the part 5 of the GSTR 9. Before we get into clause wise, some statutory compliance which we must understand. The turnover limit is 2 crores for GSTR 9, and this has to be seen on a pan level basis. The turnover limit for GSTR 9C is 5 crores. So those persons below 5 crores but above 2 crores are mandated to file GSTR 9 but not 9C. Although it is optional to file, that means the form is still enabled, you can still file the same. How can I know whether department expects that I have to file the return? If you log into your GST portal, there is an option to see the turnover of your GSTN, which will also be considered based on a pan level basis based on the number of GSTNs that you have. So based on this, you can see whether the department expects you to file. Let me take a simple example. Say I made an error in filing in one of the GSTR 1 and 3B, where instead of showing 10 lakhs of liability, I showed in the returns 10 crore. And to this effect, because it was exempt supply, I didn't have any tax liability, I did not make any corrections. I was under the assumption that I don't need to make any 990 for that period because my turnover was less than 2 crores. But because I disclosed to the GST authorities that it's 10 crores, no corrections were made, department will expect that you file the return. So to this extent, we need to ensure correction in the subsequent returns. We also need to ensure that our total which is there is being seen correctly. Sometimes those persons in real estate sector are also putting land values in the GST returns. At that time, even though it should not be part of your aggregate turnover, for the purpose of GST portal calculation, it is coming more than 2 crores or more than 5 crores. So to this extent, be clear about what is required to be filed either on a logical basis or from the GST portal basis. Wherever you do not need to file, but the system is asking you to file, first and foremost, you can dispute it where the actual turnover is less than 2 crores, less than 5 crores. But department will insist based on the data which is available on the portal. To avoid disputes, you can file the GSTR 990 on an optional basis. For the purpose of identifying and understanding the entire GSTR 990 for a financial year, this management report is suggested to be maintained. First and foremost, all reconciliations of outward, inward, and RCM, any variances which are there, reasons for variance must be documented. It need not be that we have to match everything to nil. Wherever additional liabilities were noticed, that has to be considered for the GSTR 9 purpose, and also the details can be maintained with the payment documentation, that is DRC03 reference number. So ARN number can be documented in the single sheet. So when I'm saying management report, I am suggesting a single Excel having all these details and the spillover transactions which are in relation to mainly the deferred ITC or any spillover transactions with respect to outward supplies also should be maintained in the single document. Later on during the departmental audits, this document will prove very useful in explaining and providing the consolidated database for the entire year. Now we are coming to important reconciliations which we have to maintain before we get into filing the GSTR 9 and 9C. First and foremost, the AFS turnover, that is the total revenue, not just the operating revenue. It should also include the other income, and the total value must match to the total of table 5A that you have disclosed. If you have multiple GSTNs, all the GSTNs total 5A if we consider, it should match to the total revenue as per my AFS. Next, we come to table 5N versus table 17. This is the outward supply total values. Plus, we also need to consider table your table 17, which is your HSN outward table, which is mandatory. So this is an internal check which could also prove and understand whether you have missed out any transactions. Sometimes if there are schedule 3 items included in GSTR 9, those may need to be excluded in table 17. Advances also need not be disclosed in table 17 because there is no specific HSN for that which we can consider. We can always give the HSN details when the actual invoice is raised. Outward taxes liability as per books versus 3B plus any liability paid through DRC03 must be documented clearly. GSTR 1 versus GSTR 3B also should be ideally maintained. This is easily available also in various platforms. You use ClearTax, GSTZen, all types of tools which are available online also give this 1 versus 3B. Additionally, if you see point number 4, there is a rate-wise liability as per workings and rate-wise liability as per books. When I say rate-wise liability as per workings, I mean the working that was used for filing your GSTR 1 and 3B. Why must we match it to rate-wise liability as per books? This is important when you come to GSTR 9C because 9C you need to provide the details as per books of accounts, and there again you need the rate-wise details. The reconciliation which will be done in table 9 of 9C is very important, and therefore this point number 4 has been considered as an important reconciliation for the annual returns. Inward taxes, credit as per books versus credit as per 3B. If you see here, we are talking about total credit for the year. That means total procurements minus what has been utilized. With the opening balance, we come to the closing balance. But for the purpose of GSTR 9C, we'll be considering only total credits, and therefore we need to do two sets of ITC reconciliation. One is for the total credits for the year versus the 3B, and another one is your closing credit balance books versus GST portal. There could be a scenario where there is no closing balance in the books. In that situation, you need to confirm that in the GST portal also there are no closing balances of credit as on March 24 which are available. Spillover transactions, please have a separate reconciliation for the same. Have invoice level reconciliations. Very commonly seen that these spillover transactions or transactions which you consider for the next financial year are maintained as an overall variance. So they take the overall variance for the year. Whatever is the variance, they say that this will be adjusted in the next year. But whether actually it is adjusted, which invoices were adjusted, whether there was something which was missed out, those specific invoices to identify, we must have an invoice level reconciliation, and we will be able to prove to the department also that these were considered in these returns going forward. Wherever not considered, you can consider for the first time where it is a liability. Now we come to clause-wise analysis. I have provided the past updates which were there, but I will speak mainly upon the recent changes which have been brought about for the financial year 23-24 in the annual returns. First and foremost, with respect to e-commerce transactions, where the e-commerce operator is liable to pay the tax under section 9(5). And in this, the e-commerce operator must report in table 4G1 with the taxes and the taxable value, and in table 5C1 the supplies which are made to the e-commerce operator where he is liable under 9(5) will come under table 5C1. So these two rows have been added in the GSTR 9, and to this extent in table 5N the formula and the wordings have been modified. They have also included GSTR 1A for in the instructions in the GSTR 9 form, but GSTR 1A came about only for the financial year 24-25 onwards. So therefore, for this financial year, this change in the rules does not have any effect. The biggest change in GSTR 9 is the fifth point, which is table 8A will depict ITC as per table 3I of form GSTR 2B. Earlier it was GSTR 2A, now it has been made GSTR 2B. So if we go back to the history of the ITC tables, in financial year 22-23 we had the data auto-populating from GSTR 2A, but the GSTR 2B was brought into the GST law from 1st January 2022. Section 16(2) AA also was introduced from the same date, and to this effect, the Act and the rules were introduced for the matching concept from 1st January 2022. So very common question which is there is, sir, for the past period, what is the reason why we have been asked to do the matching? This is because they had introduced rules 36(4). Even though there was no parent act, they still were enforcing the taxpayers to display the matching. To this effect, circulars were then released in circular 183 and 193, providing for option of getting the vendor certificate or CA certificate to prove that the credits are genuine. Again, whether this is legal, in my view, no, it is not legal. But because they have given a via media to prove the credit genuinity, we can still follow that instead of going for the entire lengthy litigation of disproving the 2A applicability in the first place. So for 22-23, even though it was applicable, there's still table 8 reconciliations required us to do the RICO as per GSTR 2A, which could be disputed. But from this financial year onwards, financial year 23-24, we can say that the GSTR 9 form has been brought and has been aligned with the GST law. Therefore, table 8 reconciliation till date was not being given too much emphasis. But from this financial year onwards, I feel this table 8 RICO is going to be given a lot of weightage. We will come to how the disclosures must be made. Recent GSTN advisory on ITC disclosures also had come out in 10 December. We will be discussing that too. Coming to our outward supplies with taxes and RCM, this table is having those transactions which have a tax implication. And to this effect, the data, most of the data you will get from your GSTR 1 and you can cross check with your GSTR 3B whether it has been paid. One very important aspect, table 4IJKL, that is your credit note, debit note, and upward and downward adjustments. These must be disclosed separately. In 2021, it was optional. From 21-22 year onwards, we come to credit note. There could be certain disputes or difficulty in understanding where we must disclose the same. Reason is the table 4I uses the words credit notes issued in respect of transactions specified in B2E above. So say a transaction of 23-24 where the original invoice was raised in 23-24, credit note was raised in 23-24, we will show it in 4I. No dispute. But where the credit note was raised in 24-25, there are some persons who are considering it in 4I, saying that it is in respect of transactions specified to in B2E above. Now this disclosure could have one variance when you are going to a GSTR 9C reconciliation, because such credit notes do not form part of your turnover for the year. Ideally, we must disclose it as part of the transactions where if it is accounted in the next year and also disclosed in the next year, it must not come into the disclosure of 23-24. But where it is accounted in 23-24 but only disclosed in the returns of 24-25, we can then push it to table 11 of GSTR 9. That is your spillover transactions or transactions of the 23-24 year which are shown in 24-25. So these are few variations of credit notes and their disclosures. Financial credit note must not come into 4I. One additional tip with respect to this table, if you see 4B, C, D, E, I, J, these are transactions where ideally your recipient would have a GST number and therefore there would be a requirement of raising the e-invoice. If you see, I have not given advances, 4F is not given. It is only on those transactions where you need to raise the e-invoice. But in this situation, whether we need to raise with respect to 4G, there was some clarification that because it's self-invoice, you need to raise e-invoice. So even for the inward supplies, there could be a requirement to do the e-invoicing process. But the main check here is to ensure that whatever e-invoices were raised, all such transactions have been disclosed in our GSTR 9. Wherever those invoices were cancelled in the books of accounts, but in the portal we were unable to cancel, we must have the specific data also for the same. Please keep in mind, department also has the same details, so they would be able to do the similar form of reconciliation which we are suggesting. In 4F, you need to put the net value of total advances which were paid in the year and total advances which is adjusted in the year. So net value has to be put in 4F. There could be a situation where the adjustments in the year were higher than the advances paid in the year. To this extent, 4F allows negative figures. Checkpoint for RCM, which is one GSTR 3B table, you can see where RCM liability is paid. Additionally, you can refer GSTR 2B, where the vendor has filed the invoice as RCM liable transaction, where he's put yes. And to this extent, please confirm whether you have paid the liability or not, because similar questions would be asked by the department. Wherever it was not your liability, you need to also prove that you have communicated to the vendor that it is not your liability and he is required to pay. In the IMS system, which was recently introduced as an optional system, there they have given no option to reject and accept these RCM transactions, because if it is a situation where the recipient does not pay tax and even the supplier tells that the recipient should pay tax, the eventual situation which arises is that neither supplier nor the recipient are paying tax on the transaction. Department will first approach recipient and ask him why you have not paid tax, because supplier has put RCM liable under as a yes in the GSTR 1. So communication with taxpayer is very important, and even with this IMS being introduced, the basis of the system is to ensure that the vendor and the customer speak with each other and ensure correct filing and correct credit claim. And if there are any issues, it seems to be that now department is modifying the systems to ensure they can attack the recipients first. Any additional liability, of course, can be disclosed in this table for the first time. Similarly, in table 5 also, any additional turnover can be disclosed. Here there is no tax implication, these are only turnovers. But what are the tips with respect to this transaction? First and foremost, table 5F, which is non-GST supply, they put in brackets, includes no supply. That means this includes transactions which are covered under Schedule 3 of the GST law, which is those transactions which are neither goods or services. Please keep that in mind, neither goods or services. But non-GST supply means those goods or services which are not leviable to tax, that is GST. So this includes those goods which are kept outside the purview of GST, such as alcohol, therefore, if you are including these transactions, you need to be careful when you're doing your 5N versus table 17 HSN reconciliation. Next, very important tip, which is table 5C, D, E, and F. Here, these are supplies where the either recipient is paying tax or no one is paying tax on the transaction. In these situations, as a supplier, all these transactions attract ITC reversal under Rule 42 and 43, which are specifically disclosed in table 7C and 7D of the GSTR 9. To this effect, what we can check is if we are having transactions which are provided in 5C, D, E, and F. In this situation, we must confirm that there are also ITC reversal which has been disclosed correctly. Or this could also be seen in the reverse manner. That is, if there is Rule 42-43, we must see whether we have disclosed the data which are there in these tables. In the table 5, the credit note, debit note, and the amendments are not mandatory. These still remain optional. So that means net figures can be shown up to 5F. 5A and B, these are transactions which are zero rated supplies as per the law. We must ensure that LUT is available for the period. If not, condonation must be filed. And to this extent, you can also do an additional check where you're a professional or a management. You can verify whether refunds have been applied appropriately with respect to these transactions disclosed in 5A and 5B. All the data ideally you can get from GSTR 1. other than probably the schedule 3 items. So any doubts with respect to outward supplies? I can take it now. FY 22-23 transactions captured in GSTR 1 and 3B of 23-24 in any table, same needs to be disclosed in GSTR 9. So transactions with respect to the previous year, I would assume that these are transactions which are captured in the books of accounts of 22-23, but only disclosed in the returns of 23-24. To this extent, while filing GSTR 9 of 22-23, it would have been disclosed in table 10 and 11 of the GSTR 9. To this extent, we must ensure that such transactions are not disclosed in these tables of table 4 and table 5 because they are not financial year. What is the impact? Impact here would be that your table 9 of your GSTR 9 tax payable versus tax paid will show a higher value in relation to tax paid, but because we are not disclosing it in table 4 and 5, there will be a variance in that table 9 data. In this situation, we must maintain reasons for variance. We need not add or edit the tax payable in table 9. Additionally, once we do this, when we are matching GSTR 9 with our 9C, which is books of accounts for 23-24, because we have removed these transactions of 22-23, the data will match. So we do not need to disclose these transactions in the GSTR 9 of 23-24 because they have already been disclosed in the 22-23 annual returns and matched with the 9C of 22-23. Unbilled revenue, you do not show in GSTR 9. These are adjustment items in 9C. They will be discussing on that in the next part of the session. Dividend income to be shown under exempt income or non-GST supply. Again, in my view, dividend income need not come in the GSTR 9. It can be a adjustment item in table 5 of the 9C. The reason I say this is dividend income is a derivative of your securities transaction. Securities transaction itself, for the purpose of only ITC reversal, we need to consider 1% of the sale value. So dividend income does not come into the picture at all as a income that you have generated by supply of goods or services. So when it is not goods or services, in my view, we do not need to consider. If you are want to consider anywhere, 5F would be the only place where you can consider the dividend income. Alternatively, I do suggest that it is considered as a adjustment item in table 5 of 9C. Amendments of B2CS related to 22-23 done in 23-24 GSTR 1. In GSTR 9, 23-24 auto-populated in B2CS such above effect. What do we do? Yes, you need to remove such amendment effect. I am assuming when it is come in GSTR 1, it is also paid in 3B. So to this extent, if it is a transaction of 22-23 shown in 23-24, it should have been shown in table 10-11 of GSTR 9 of 22-23. If that is also done, that is again one more additional proof. And then you can reduce it in your table 4 of GSTR 9 of this year, and you can ensure the matching in the GSTR 9C. RCM payable of 23-24 shown in 3B of 24-25. So to this extent, because table 10-11 in the spillover tables, which is your transactions of 23-24 shown in 24-25, these tables taxable value is considered for the purpose of matching your turnover with your financial statements. As RCM is not your turnover, the RCM taxable value need not be considered, but the taxes can be considered in table 10 and 11. So any additional liability of RCM paid or any reduction of any RCM liability done in 24-25, you can show in table 10 and 11 only to the extent of taxes. This will also help with your matching when you are doing your table 9 of 9C reconciliation. Bank FD interest comes under GSTR 9 or not. Again, there are two views here. One view is you show it in non-GST supply or you show it in exempt supply, because interest income is exempt supply for the purpose of GST. Second thing is, if you don't want to show it in the returns, because then this indicates that you have to do ITC reversal, you cannot show that it is interest here. You can alternatively consider it as a 5O adjustment. ITC reversal is not required for interest income as per the explanation to Rule 43. Invoices of 23-24 reported in 24-25 returns. Even if it auto-populates, you need to remove it, is what our view is. Can we report zero rated supply in 99C even if we haven't reported in the GSTR 1 during financial year 23-24? Yes, you can report it for the first time here, but whether your refund will be processed based on this disclosure alone, you may have to think about it a little more. In my view, this can be a basis of saying that it was missed for reporting and therefore it has been reported. Based on this, with the proof of actual transaction, going for refund under others may be possible. So you can disclose for the first time transactions here. RCM liability recognized during prep of 9. Can this be reported in 3B of November or December? Additionally, is ITC allowable? So this depends on whether your RCM liability itself is with respect to registered or unregistered vendor. If it is registered vendor, the registered vendor is ideally supposed to show that this is the tax portion and you are required to pay under RCM. And to this extent, because we have already passed the time limit, credit would not be eligible. But assume that it is a transaction of 23-24 and vendor is unregistered. In my view, you can take the benefit of circular 211, where it says that self-invoice can be raised now and credit can be claimed. But please keep in mind, Rule 47A has been introduced from 1st November 2024, where it has given time limit to raise self-invoice for 30 days. So which means any liability from 1st November 2024 onwards, you may not be able to use circular 211. So for Mr. Sandeep, for 23-24 RCM liability, if it is eligible credit, please raise self-invoice now, claim the credit in the upcoming returns where the vendor is unregistered. For the transactions, same answer I will not give for the next year, because next year we'll have to see whether the liability is before 1st November or after 1st November once the rule for raising the self-invoice has been given. Some transactions shown in B2CS by mistake. In next year, such transactions amended in B2CS by amendment and show new invoice in B2B. It should be shown in table 1011. Yes, it can be shown in table 1011. If it is the same values, you can also avoid the disclosure. But for better disclosure, I would suggest to show it in 10 and 11. We have reported invoices of 23-24 in 24-25 returns. I think we have already answered this, sir. So if it is auto-populating, you need to remove it because it would have been shown in the sorry, this is for 23-24, 24-25. So if these transactions will not auto-populate in the GSTR 9, you must consider them in table 10 and 11. So table 4 will ideally have only transactions of the year in the year, not which are shown in the next returns. So 24-25 disclosed transactions must come in table 10 and 11 of GSTR 9. Okay, so we had a good interaction with respect to outward supplies. We will now move into the ITC. ITC, first and foremost, we need to understand the credit claim basis. Whether credit is claimed based on books only, whether credit is being claimed only based on 2B, that means entire 2B I will claim, or credit is based on the matching concept provided in the law. So this last option is ideally the option which is appropriate as per law, and also the position which can give you invoice level reconciliation and help in your 9C ITC disclosures. So how can we ensure the invoice level data has been maintained? Can we get the details in the following format? Eligible ITC for the year, permanent reversals for the year, temporary reversals for the year, other than those which are specifically in relation to those credits which you can reclaim. That is Rule 37, 37A, Bill of Entry and under protest. Rule 37A is with respect to 180-day non-payment to vendors. Rule 37A, which in my view majority of the taxpayers are not following. This is where credit must be reversed where the vendor has not filed his GSTR 3B. We can verify Rule 37A using the GSTR 2A, not 2B. In 2A, you get the details of whether vendor has filed his 3B. Why is this again being pushed on the recipient? This is being pushed on recipient because of section 16(2)(c). Section 16(2)(c) of the law requires that for credit claim, condition of credit claim is that I need to ensure tax is paid to the government. Even though I am paying tax to my vendor, I need to ensure he has paid it to the government. The way to verify this is whether he has filed his GSTR 3B. Wherever he has not filed the GSTR 3B, your credit can be questioned basis this rule and this law. If you are reversing the credit as per 37A, whenever he files his GSTR 3B, at that time the credit becomes eligible again. Again, Rule 37, 37A, once ITC is reversed under these rules, there is no time limit to reclaim. Once payment made to vendor or once vendor has filed 3B, the credit is again eligible. Bill of entry is a disputable point. In our personal view, bill of entry is not linked to the time limit provided under the law, which is 30th November, because section 16(2) for the matching concept uses the words invoice and debit note. Second, in 16(4) time limit, again it uses the words invoice and debit note. Bill of entry is a separate document which is named separately also in Rule 36. So keeping that in mind, when they have specifically told only for invoice debit note there is a time limit to claim credit, I can interpret that the law means that any other document which is there does not have a time limit to claim the credit. Of course, departmental officers will dispute this, but in my view, in the long run, even with the litigation, this is a position that we can win, because tax is first paid to customs authority before we get the bill of entry. So to this extent, there is no vendor on the other side. There is no requirement to prove that returns are filed or the payments are made to the government, because directly payments are being made to the government itself. Next, temporary reversals under protest credit, where we have reversed under protest. We can always dispute that based on the outcome of a case law, we are awaiting the credit claim. Again, department will dispute the credit basis the same. We have seen many situations where they have asked to shift from 4B2 to 4B1. Can I still maintain my dispute that I am still under protest? In my view, yes. We can write a letter and say that these credits are being reversed, but when the case law does arise and if it is in our favor, we will claim the credit back. These options are available to the taxpayer. Next, ITC of GSTR 2B, which is not relevant to customer, whether it is shown in 4B1 or not. This is again the ask of the departmental officers, where they want data to be put in the permanently reversed ITC so that they get the benefit of the revenue. Whatever you put, to that extent, SGST portion goes into the kitty of that state. Other than this, I'll come to the 80 negative values in the subsequent slides. Table 6 discloses our credits from table 4A of 3B. So this means that any credit where you have done 2 times will reflect in 6A. That means once when I have claimed and done a temporary reversal, and second time when I reclaimed it, either I've reclaimed as eligible credit or I've reclaimed it and then put it in permanent ineligible credit. In both the situations, it will arise twice in table 4A, and therefore in this table 6A of GSTR 9, this data will appear twice. But in your GSTR 2B, that entry will appear only once. How do we take the decision on that? We will come to that. All the other tables here have a bifurcation between input, capital goods, and input services. Input and capital goods are mandatory. Input services is optional, can be clubbed with the inputs. Majority of this data, you can take the GSTR 3B as your source, because you cannot show credit claim for the first time in table 6, because it can be claimed only through GSTR 3B. But when we come to table 7, you can show ITC reversal in the GSTR 9 for the first time, because it is a liability. Show it in the returns of December. I would also assume that because it was unknown that the liability was there, and only now it was identified, even the accounting for such liability is done in the month of December. So to this extent, it's a transaction of 24-25 shown in the returns of 24-25. To this extent, it does not warrant any disclosure in 23-24. So now we come to ITC disclosure and how we can disclose in our returns of 23-24. So if you see, there are three bases. One is accounted period. Next is to be reflected period. The next is 3B claim period. When I say period, it could be any of the months within this financial year. So for ease, we have just taken financial year as the basis. Assume that ITC is accounted, to be reflection, and 3B claim all have happened within the same financial year. It will go to table 6B. Next, we come to ITC accounted and GSTR to be reflected in 23-24, but GSTR 3B claim happened in 24-25. In this situation, this is a spillover transaction, so it will come to table 13. And because it is there in 23-24 2B, it will also be disclosed in table 8C, because I need to match the reconciliation of 2B versus credit claimed. Because I will not be showing it in table 6B, it will not auto-populate there for reconciliation, so I need to consider in 8C for the disclosure. But let's take similar example, but 2B reflection happened also in 24-25, not in 23-24. To this extent, I should not show this in table 8C, but I will show it in table 13 because it is accounted in 23-24. So if you see the superscript for the first one, disclosure which is there in this table 6B will need clarification declaration. To this extent, one very important thing which we need to remember, department's view on such type of credit claims may be different. They may expect that you put these transactions also in 8C of the returns. So if you see the last item, which is financial year accounted is the next year, but to be reflection is in this current year, and 24-25 also the credit has been claimed. So the only relevance of the 23-24 is with respect to be reflection. In my view, we should consider in 8C, but we need not consider in table 13 because it's not a transaction of 23-24. But in the advisory, they have informed that we need to show it in both the tables. In my view, this is something which is not right. Next, we come to the financial year of 22-23, which is disclosed in 23-24, reflection of 23-24, and GSTR 3B claimed in 23-24. This is basically last year transaction, which is reflected in the 3B of the current year. This will come in table 6B because it is part of 2B of 23-24. Please keep that in mind. Similarly, if it was not part of 2B of 23-24, if it was part of 2B of the previous financial year, because 6B is going to my reconciliation tables, I will put it in 6M. This 6M is a alternative table which can be used. Again, whether department has clarified or advisory has come, no, there is no clarification provided for this. But in our view, this is not to be disclosed in this manner. Therefore, we should show it in 6M, which will help and aid the reconciliation process. Next, we have 23-24 accounted credit to be reflected in 24-25, but 3B is claimed in 23-24. This is basically where credit is claimed based on books of accounts, but to be reflection has happened in the next period. Here, there could be two options. If you show it in table 6B, you will have a table 8 reconciliation difficulty. And to this extent, in my view, the department has told they should go to 8C and table 13, which is again not appropriate. But in this situation, if you show it in 6M, it would be more appropriate for the purpose of disclosure. Alternatively, there could be an option to disclose in 6B, but also give a reason for variance in table 8. Because it is a credit of 23-24, it is better to disclose as input or capital goods rather than show it in 6M, but you will have a variance when you are filing the table 8. So if you see here, each and every type of variation of credit claim has been covered and the disclosure has been provided. Whether this disclosure is mandated by government, answer is no. This is the disclosure that we have identified and analyzed and ensured the most appropriate disclosure considering the various requirements of reconciliation within this annual return. So advisory came out saying that ITC which is claimed, temporarily reversed and reclaimed in the same financial year reversal which is there, you need not disclose at all. What happens is your 6J and 6O of your table, there will be a variance, but that is fine because department now itself is giving a advisory. But please keep in mind, this is not a circular as per which is issued by the CBIC. This is only an advisory issued by GSTN. So to this extent, whether the departmental officers are bound to follow, answer is no. But practically will they follow? Because it's coming from the government representative, I feel it would be followed by the department officers. So option to not disclose. So when we were earlier discussing, 2 times credit will come in table 6A, but I will show only once in 6B. Where it is ineligible credit, I will show the reversal in table 7. Where it is asking you to use table 8C, but in our view, there is no requirement to make these adjustments. So the other situations or issues which are there as part of the GSTN advisory, they have not clarified with respect to credit notes how they should be disclosed because there are different practices in the industry. Credit vendor credit notes, if they are not acceptable, instead of being added back to 4A5, it is being reduced from the temporary reversal. So this disclosure, how it must be reversed, we need to see, because if it is followed through in the same manner, then you would not disclose it in the returns. in your table 8 reconciliations, your credit note value would be there as per 2B, but it has not been considered. So your credit claimed will be higher, leading to a difference between 2B and ITC claimed. So ITC claimed based on books with 2B reflection in next period, whether 6B or 6M. There is no clarification in the advisory. Our view is, of course, to consider 6M if you're okay with the variance in 6J. If not okay, then you can consider in 6B and have the variance in table 8 and give the reasons for the same. Similarly, in the transactions with respect to 22-23 ITC reflecting in 2B of 22-23 but claimed in 23-24, should we still use 6B or can we disclose in 6M was not clarified. There could be certain reasons where table 8D is negative. Let me disclose table 8D here first. So table 8A is your ITC as per GSTR 2B. 8B is ITC which is auto-populated based on 6B and 6H. Please keep that in mind. The credits, and where 8D, that means where 8D is positive or negative, we need to provide the reasons or have the reasons with us. Where 8D is positive, we need to match 8E and 8F. We need to fill them that ITC is available but not available, ITC available but ineligible, which means that ITC is higher in 2B than what is claimed. This is the position to be at. This is the acceptable position where department is not going to raise much concerns because you are disclosing that there was more credit, but I claimed lesser than that. So to this extent, this is the position which is acceptable. Where 8D is negative, that means you are saying that total credit claimed in 6B and in the next year with respect to these transactions, the credit claimed is higher than what is reflected in 2B. This is directly against the provision of law where it says that credit should be claimed only after matching with 2B. So department could use that as an indicator, as the basis for asking for more information and then converting it into a demand. What could be declaration requirements in table 8D? First and foremost, if there are credit notes which you have not accepted, not disclosed in your table 6, to this extent, it will show that 2B value is lower, but ITC claimed is more. And to this extent, we need to have a separate documentation. There is circular 212 which came out recently, which said that we need to ensure that wherever credit notes were raised and this credit note has been, ITC reversal has been done by the vendor, by the customer, the vendor must prove to the department has reduced his ITC and only then he can reduce his liability. Because there is no mechanism presently which can allow the ITC reversal first and then only allow the credit, the outward liability to be reduced. This circular 212 was introduced as a via media. It's a temporary mechanism to get the certificates from the customer. So in this situation, if it is unacceptable credit note, please keep in mind, department will ask you to prove that you have not reversed your ITC. And to this extent, they may harass you to make the payment, but ideally they must go to the supplier and ask him to add back his liability. There could be situations where the original invoice and the subsequent credit note both were not accepted in 2B. To that extent, you will not have a negative 8D because net effect in 2B will be nil. So this is only in those cases where credit note has not been matched at all in the ITC disclosures and where it may have been actually required to reverse, but it has not been reversed. So please do go through your unaccepted credit notes in your GSTR 2B. If not, if you already have the list, where it is clearly unacceptable in your view, maintain that you may have to provide a declaration on a proactive basis to ensure the department later does not say that you have withheld any information. Next is the credit of 23-24 ITC reflected in 2B of 24-25. In this situation, sometimes the taxpayer is showing the credits in table 6B. If it is done so, there will be a variance because it is not in the 2B of 23-24. Therefore, 2B values will be lower. ITC as per the table 6 is higher, showing a negative 80. Again, to this extent, disclosure or declaration can be made. When I say declaration, this is a simple Word document where it is on the letterhead of the taxpayer with the authorized signatory signature having the details of these transactions. This can be made into PDF and uploaded along with the documents when you are filing the 9C. So when you are filing 9C, you are supposed to upload the balance sheet and P&L. Additionally, other documents also can be uploaded, which could be the AD negative declaration. This is a proactive approach. Whether it is mandated by law, no, it is not mandated, but it is one of the best practices to avoid unnecessary questions and prove that to the department that you have given all the information which you have. So to sum up this disclosure which is there, the left side has the GST and advisory. Option 2 is where 6M can be used. Option 3, which is not suggested at all, is table 6B, 6H. Let us assume in this situation that total auto-populated is 5,000. The double credit which is there is 2,000 to this extent. Actual eligible credit is only 3,000. When I say eligible, that is eligible and ineligible credit which is reflecting in 2B. So to this extent, the first option what GST and advisory is asking you to do, disclose in table 6B only once. So show only 3,000. You will get a difference of 2006J and 6O of the table. They have not clarified and said that you should disclose in 6M. So assume that also is blank. You need not disclose these reversals in table 7. So on an overall basis in table 7J, your net ITC will match GSTR 3B, which is the intent of the disclosures in GSTR 9. So net ITC as per table 4C of 3B for the total period versus table 7J should match. This is an internal check which you should maintain. In option number 2, the only change is you can show that 2000 in table 6M to ensure that the total ITC matches in table 6O. What is the implication of this? I do not see any additional implication of this. In both the situations, your GSTR 2B reconciliation in table 8 is not affected. The only thing is in the second option, 6O at least will match. But if you would like to follow the advisory, then you need not disclose in table 6M. Option 3, in my view, is not acceptable. I have just displayed it here. I will not explain the same because it will confuse rather than clarify any further. ITC reversal, we have rule 37, 180 days. 37A, if you see, is not listed in the table 7 specifically, but there is always table 7H, which is other reversals. 39 is with respect to ISD reversal. 42 is input and input services related ITC reversal, which is used for exempt supply or non-business activity. 43 is for capital goods. The format and the formula which is there for 42 and 43 both are different. Please keep that in mind because if there is a fluctuating exempt ratio, keep this information in mind. Rule 42, where annual recomputation is required, also has a different timeline than 30th November. Annual recomputation needs to be done by the September month timeline. That means your 20th October would be the last date for disclosing such credit claims or credit reversals which are on the account of annual recomputation. 7FG which are in relation to TRAN generally does not happen, but if there is some court order for that year, then yes, you may consider here. Table H7H can be used for disclosing all the ITC reversals, but I would suggest if you have the information and the bifurcation, please display in the correct heads. It will help in explaining and also keeping your own internal reconciliations clear. All broad block credits you can disclose in 7E, that is as per section 17.5, if there are any ITC reversals can be disclosed here. So table 8 reco also we have discussed. Before we go to table 9, we will take any questions. I understand there are a lot of information given in the last 20 minutes, 30 minutes. So any doubts with respect to ITC disclosure, if you have not understood, please let me know. We can discuss them here. Table 13 is optional. Should we report amount in table 13? Yes, it is optional. But like I said, if you are doing the reconciliations on an invoice level basis, you have clear information on what should go to table 13. I would suggest to disclose it in table 13. Even though it's optional, it is a better practice where all the information is available. For those persons who have not maintained robust reconciliations, then 24, how to disclose the same. So here what I understand is you have claimed the credit in 22-23, and in the books also it was an ITC credit claim. But the same was reversed in books, and also it was reversed in the GSTR 3B. To this extent, I suggest that there is no overlapping which needs to be done, because the accounting of credit claim and the accounting of reversal and the corresponding claim and reversal all have happened in their respective financial years. So last year it would have been part of table 6. It would have gone to your GSTR 9 and matched with the eligible credits. This year you have reversed it in your books, and you have also reversed it in your table 7 of your GSTR 9. It will disclose. Let it disclose in these tables, and automatically the credit also will be matched in your 9C. Circular 170 followed ITC as per to be availed and reversed. In this situation, how classify inputs or capital goods? So again, Mr. Sandeep, what they have told very clearly here is whatever is your eligible credit, which you have matched, which you have reclaimed. So if you have not reclaimed, let us assume a scenario where ITC claimed, you don't know whether it is your credit or not, you have passed it in temporary reversal and you have left it in that table. For the entire year, it was not actioned upon. Even up to November, you have not actioned upon this. Your credit is now lapsed. There is no option to reclaim such credits anymore. So to this extent, ideally what you must do is in the forthcoming months, you will have to reclaim and then put it under permanently ineligible credits. In the situation that you had reclaimed the credit as eligible or ineligible credit, so second time it came, that was the actual claim of the credit. So at that time, you will have to disclose that item in 6B. Whatever was claimed and temporarily reversed, they're asking you not to disclose at all in GSTR 9. As it has neutral effect, plus minus, there is no value variance also in these disclosures. So they're asking you only to disclose the actual credit claim, not the claim and temporary reversal. Amount of 8C should be shown in table 13. Ideally, yes, but not in all cases. Like I mentioned in this table, if you see 8C and 13 has only one nature of transaction, but table 13, if you see, is mentioned once, table 8C is mentioned once. Both are exclusive of each other. They won't disclose in either of the 8C or 13 for that period. 6M is not equal. Dugi Sethi sir, you have mentioned the table 6M is not equal to table 13. I am not understanding your question. Can you please rephrase? ITC reversal in case of RCM. Can you please rephrase your question, sir? Reasons for difference between table 8A and 2B of 23-24. So this we do not understand presently why there is a reason for variance. Ideally, it should not be there. If you are having variances between table 8A and 2B, please raise grievance for the same. Have specific workings which are maintained separately. And when the department does come, you can also download table 8A invoice level details. You will also get 2B invoice level details. Please do a matching of the same and see if there are any variances between these two tables. So if it is there, understand the reason. Ideally, in my view, there should not be any reason, because all those credits which are time barred, all those credits where place of supply is different, those are directly moved to ITC not available. And those tables will not be considered either for 2B nor for 8A. So I am not able to understand what is the reason for difference. One possible reason could be the amendments with respect to these transactions. Other than that, I do not see any specific reason. Table 8A auto-populated from 2B, 8B is equal to 6B to 6H. B2B total for FY 23-24 less ITC take for 23-24 during April to October, which is to be shown under 6M. Yeah, for that is 22-23 related credits. Then 8C 23-24 financial ITC taken in 23-24 till October. 8D difference may not be there. In 7E we have disclosed ineligible ITC as per 3BS. So I think this is more or less fine. Ideally 8D difference would be minimal. Wherever you have claimed to full 2B and you have considered in the temporary reversals, and it's also been reclaimed in that same period. Wherever it is moving to table 13, 8C and table 13, so to that extent then the credit would be matched entirely. So any credits which are sitting in 2B which are not relating to your transaction or your entity at all, where you have not done a reversal or not taken any action, those may be sitting as a positive 8D variance, which can be shown as ITC, which is available but ineligible. Supply of services towards exempt and taxable goods is the ITC should be taken on proportionate basis. Yes, ITC should be taken on proportionate basis. You can refer rule 42-43. There is a format which is provided for the credit claim. So you need to reverse the credit to the extent it is relating to the exempt supplies. You need to map those credits which are common credits between taxable and exempt supply, and only to those ITC you need to apply the reconciliation. For capital goods, there is a separate formula given, which is for over 5 years, which you need to perform the reversal. So please see for input services and capital goods and follow the appropriate formula. What if table 7 of GSTR 9 does not match with reversal of in table 4B of 3B. So this again, there is no clarification which is specifically provided, but what they mean to say is if your permanent eligible is there, that you must disclose in 3B. So to the extent that you have disclosed permanently ineligible credit in 6A and you have also done it in 7, to this extent you have to show it in 6B and 7E or 7H. So to this extent 4B1 table will be disclosed. 4B2 table as per the advisory need not be disclosed in the GSTR 9. So as per advisory, 4B2 need not be disclosed to the extent of the credit which has been claimed and reversed and also has been reclaimed. Can we show amount of 4C, that is net ITC available of 3B in table 6B showing reversal details in table 7? Conceptually, yes, you can do this, but please do verify whether you have transactions of previous year coming into the present year, transactions of present next year which are shown in the present year 3B. So these below transactions based on the table on your screen, you may please have a look and consider. But in a sense, what you have mentioned, Mr. Adarsh, is appropriate. In GSTR 3B, the total ITC was declared in 4A5 while the temporary reversal was declared in 4B2. Okay. Subsequently, reclaimed ITC was shown in table 4D1. Could you confirm where the temporary reversal for B2 and the ITC reclaim from 4D1 should be reported? Like I mentioned, sir, it should not be reported anywhere. Only the final reclaim will be shown in 6B. If it was permanently eligible credit, it will be only in 6B. If it was claimed and reversed, then you'll show it in 6B and you'll show it in 4B1. The reason I'm saying 6B is because those ineligible credits you would have matched with 2B and then only confirm that it is ineligible. So to that extent, 6B disclosure is there. If it is permanently ineligible, additionally, you will show it in 7E or 7H. Whatever was claimed and temporarily reversed, you need not show it in your GSTR 9. That is what the advisory says. Alternatively, if you are not satisfied with that reasoning, you can use option 2, which is on your screen, which is using table 6M. But if you ask me, show me the law which says that you can show it in 6M, there is no law. This is our view that you can use this option also to avoid the table 6O showing a different figure than 6A. 6M is not equal to table 13. I have not seen such an error, sir. If you are having the screenshot, my email ID will be shown at the end of this session. You can please send it to my email ID. Where such RCM paid in 23-24 and the same shown in books, but claimed in 24-25 to be where to be shown. Okay. So what I understand is RCM is paid in 23-24, even in the returns, but credit was claimed only in 24-25. So only with respect to ITC disclosure, this question is arising. To this extent, we can show it in table 13 because it is, I assume that the credit also would have been, credit entry would have been passed along with the payment entry. And to this extent, it's a transaction of 23-24, which is claimed in 24-25. So to this extent, table 13 can be used for RCM ITC, where you have accounted the credit in 24-25 and claimed in 24-25. You can show it directly in next year table 6. Need not disclose in table 13 of 23-24. ITC accounted in 23-24 and claimed in 23-24, but reflected in 2B of 22-23. So this is clearly given here, sir. if you see the table 6M, which is, one second, sorry, it is not a 6M, ITC, this will come in table 6. 22, 23. So here you have two options, sir. If you see the last table I have given with respect to the next financial year, but it is the same effect. So 6B, table 8C, which was there, you can disclose in the present year. What will happen is in 23-24, you can show it in 6M because the transaction is there only in this financial year, but it is the part of the 2B of 22-23. So in your table 8 RICO, this transaction will not come. So if you see in this table, in table 8A, the transaction will not reflect. But if you are shown in 6B, then there will be a mismatch. To avoid that mismatch, you can use table 6M. Should I show other reversals if remained unclaimed in table 7? Reversal that has not been actioned upon. So if that is the case, in my understanding, because the time limit is already lapsed, because you have not moved it to 4B1, the credit is not eligible. Department would like you to consider that in 4B1 now. Even though there is no liability because already the credit was reversed, it is suggested that you reclaim and push it to 4B1 in the present returns. Also, because it was shown in 4B2, you can also disclose in 4D1 to ensure your ECRRS balance is not damaged. So, suggest to consider 4A5, 4B1 and 4D1 in the present returns where time limit has lapsed. We have wrongly reported RCM input in 4A5. Whether we should reconcile this because 8B is not matching with 8A. So presently what you can do in your GSTR 9, you can disclose it in the correct head. So you can move it from table 6B, you can move it to table 6C or 6D. And once you make this move, there will not be a reconciliation issue in table 8. GST paid on advances in 23-24 but not adjusted against tax invoices till 30th November. Whether this can be adjusted in December 24 onwards. What if advance is received from party A and invoices are of party B? So first and foremost, there is no time limit for adjusting advances. The concept of advance is that because you are receiving amount in an earlier stage compared to when you are raising the invoice, they are asking you to pay the taxes against those transactions. For goods, they have correct or not, tax is being collected on advance payment. Whether there is a supply, answer is no. So to this extent, until tax invoice is raised, the supply is not established. So to this extent, you can raise the supply invoice without any time limit. There is no time limit to perform a supply. They cannot put a time limit on your business. Now, question which you are asking at the end is, what if advance is received from party A and invoices are of party B? So to this extent, what is the relationship between party A and party B? Why is party A making payment on behalf of party B? This is something where in the books of accounts, you will have to show the debtor of party B being settled against advance payment of party A. So that is only internal book adjustment. But from the perspective of advance and invoice, I do not see any issues. Your advance will come in 23-24 in 4F, and the invoice in the next period will also come. The adjustment to that extent will again come in the 24-25 period. as a adjustment in 4F. So net effect in 24-25 will be nil and it will match. If we have ITC claimed reversal reclaim, what should be appropriate columns? I think I have explained this, sir. If you are still not understood, you can please drop me an email. This PPT also will be shared to everyone so that you can go through it in an in-depth manner. Some of unknown vendors have uploaded ITC on our portal and same was not considered in any of the 3B nor reversed. How do we treat this? So in this extent, if you go to table 8, in table 8A, this data of unknown vendor data will be reflecting. It won't be in 6B and 6C. That means it will come as a positive difference in 8D. To this extent, you can put it in 8F, that is ITC, which is available but ineligible, or you can put it in 8E, which is ITC available but not availed. Ideally, available but not availed intends that it was eligible credit, but you have missed to avail it. Second one is ITC, which is there, but it is not eligible to you as a recipient. So 8F would be more appropriate to you, Mr. Mohan. ITC of 23-24 reversed in 4B2 in 23-24, subsequently reclaimed in 4F and disclosed in 41. I think again, sir, I have explained this multiple times. The PPT will be shared. You can have a look. The concept remains that because you need not disclose in 6B 2 times, you need to disclose in 6B only once. In table 7, there would be no reversal. And to this extent, because you're disclosing it only once, the total value, the reclaim and the reversal which is there will net off, and your total value which will go to your table 7H, 7J, your net ITC will match your GSTR 3B net ITC. Therefore, there will not be any variance. Which type ITC values to be disclosed in table 6H? 6H is mainly those credits where earlier the ITC was reversed. Now it is being reclaimed on account of Rule 37, which is your 180-day provision. I think even Rule 37A also can be disclosed in the same provisions. In my view, 6H has to undergo a change, because if it is an instance where the 2B was filed in the previous periods and only later we are making tax payment and only later we are seeing the 3B filed by the vendor, in those situations, it will still throw variance in our table 8 because it considers 6H. So to this extent, in my view, this table should not take 6H for the purpose of computation, but this change we'll have to wait and see if they make. In that values that are added to 8B, it will result in a difference because it's not reflected. Yes, that's what I mentioned. Even I feel that the disclosure manner of the 6H, if you see in the past periods, this was coming in 2A. So 2A, it would be based on the dynamic basis of filing. And at that time, that matching concept was not being seen on a strict basis. Now it is shifted to 2B, and first claim itself is based on the GSTR 1 filed by the vendor. So once that is filed, the ITC reversals will be done only because vendor has not filed his 3B or vendor payment has not been done within the time limit. In both the situations where it is going beyond the financial year, whenever it is being reclaimed, I do not see any reflection again in 2B with respect to those transactions. Therefore, I do not see a relevance of now 6B over here. If you are having such transactions where you are disclosing in 6H, I also suggest that a grievance be raised to the department, and you also write a letter to the jurisdictional officer that this disclosure is causing a variance in this table, although credit has been claimed as per the law. So I will move into few of my balance slides. I have 5 minutes left. First and foremost, with respect to tax payable versus tax paid, because we are adding liability in table 4 and table 5, anything that was missed out, that will automatically come into your tax payable columns. Wherever you are adding additional liability with respect to ITC reversal, say Rule 42-43 not done, block credit identified later, all of them you can show in table 7 for the first time, but has to be manually enabled in the tax payable columns. There could be reasons for spillover transactions or variance between these. I will come to that in the prospective slide. There could be another variance within tax payable and tax paid. In the situation where your ITC, that means net ITC is negative, to that extent that value will be shown here as paid through cash or paid through ITC. To this extent, there is no requirement to add in tax payable. There are of course two options. One, you can add it in 7H, show it in tax payable, and also consider in the table 9C. Alternatively, better option is not take any action, just have the reason for variance, that this is negative ITC disclosure of table 4C. Again here, I feel the department could have been able to identify such transactions and negate it from coming into the returns, but that has not been done. There could be reasons for variance between tax payable and tax paid. First and foremost, additional liability. Second, previous year liability disclosed in the 3B, which is considered in the tax paid, or excess taxes paid in the current year, which is adjusted in the next year. All these could be the reasons for the variance between tax payable and tax paid. ITC you can use by way of your additional payment of DRC03. Even though the instructions say it should be paid in cash, the instructions later were amended that the transactions or the liabilities could be disclosed for the first time. Being a self-assessed return, it is as good as any liability. Therefore, they cannot enforce that it should be paid in cash only, and ITC must be allowed. To this extent, even the online portal also allows the credit claim by using the annual return DRC03 option. Like we discussed, we have the spillover transactions. The basic requirement is to check whether ITC is booked in the current year and whether it is in the current financial year 3B. The main discussed it in the prior tables. So now I will come to some of the spillover transactions itself. So wherever outward supply of financial year 22-23 disclosed in 3B of 23-24, where it was already shown in 9 table of 22-23, table 10 and 11, it should not form part of your table 4 or 5 of GSTR 9 of this financial year. Impact, there will be a variance in table 9 and it is not compensatory in nature. Please keep that in mind. Next, we have credit note which is raised in 22-23, disclosed in the returns of 23-24, where it is shown in the 9 of 22-23. Like I had earlier mentioned in the start of the PPT, that credit note sometimes is being disclosed because it is in relation to the specified transactions above. In that case, there will be a variance which will arise. 9 will show a higher tax payable in the first period and a lower tax payable in the next financial year. This is a compensatory in nature tax payable versus tax paid of the 2 financial year impacts. The reconciliation also will need to be done in GSTR 9C. If it is done in this manner, this impact you must be very well aware of and make a note of the reasons for variance. Liability which is disclosed in 22-23 but paid through form DRC03 in 23-24. I'm telling in financial year 23-24, not the annual returns of 23-24. To this extent, this should not form part of table 10 or 12 of 22-23. Also, it should not be in the GSTR 9 of 23-24. Because the taxes were already paid, in this instance, it would have been added in the GSTR 9 or 9C of 22-23, and to this extent your tax payable would have been increased, and against this you will have a DRC information, and this again is not compensatory in nature. So these are various situations of spillover transactions and their disclosures and how it needs to be managed. If you have any other spillover transactions in your mind, you can please note them down and send it to my email ID. Balance tables are optional other than table 17, which is outward. Like I mentioned, please keep in mind you do the matching against 5n plus 10 minus 11, excluding the advances. There is a 10 rupee adjusting variance here. So even though you need to key the values up to 2 decimal, up to 10 rupee variance. Late fees now, earlier it was a fixed late fee for all taxpayers. Later on it was modified where it was made based on the turnover limits, and even in this there are separate values which have been mentioned. If you are filing nil returns in GSTR 9, then that also has a separate late fees which are prescribed. One clarification which we got through the Kerala High Court was that the same late fees of GSTR 9 cannot be applied to GSTR 9C. 9C will have the general penalty late fees, where GSTR 9 has the late fees as it is enumerated above. So departmental issues, most of them we have covered while discussing the above slides. So outward supply mismatches, what could be the reasons? We have discussed many of the spillover transactions and their disclosures. With the returns. So wherever we are filing our GSTR 9, after GSTR 1 versus 3B versus books of accounts, we will not face such departmental issues. Table 6J mismatch up to 22-23, it could be on account of these reasons. Earlier in the past periods, we were showing 6M with the temporary reversal. We were also showing the previous year transactions claimed in the current year. Now, because of the advisory, there is a change in the table 6 disclosures. And to this effect, if you are receiving any notices, please have your invoice level reconciliations and disclosures kept well in advance. 9 versus table 9 payable versus paid matching. I just discussed many spillover transactions. 80 negative have the invoice level matching. Ideally, having 80 negative is a cause of concern. It indicates that you have claimed more credit than what is available in GSTR 2B. So I have exceeded 5 minutes of my time. I think Mahadev has answered some of the questions in the chat box. So this is the email ID available. If you have any doubts, please do let me know. And I think 1 or 2 questions I've asked to be sent in an email. Please do send it to the email and I would be glad to respond to the same. Wrongly paid excess taxes in 3B, the same has been adjusted in next year 3B, in which table to report. So here, sir, what I understand is that it's a transaction. There is no options. One option, show the transaction as per the actual transaction in GSTR 9. That means in the first year where it was excess paid, your tax payable will be lesser than tax paid. In the next year also you will show actual liability. So in that period, because it was adjusted, your tax payable will be higher than tax paid. Alternatively, show the excess value in the table 4 and the adjusted value in table 10. So in this situation, you will have a matching of table 9 in the first year, but you will still have a mismatch in your next year to that extent. So please keep this in mind. You can either show in either or option format, either with respect to table 4 and table 11, or you can show the correct values directly in table 4, which has a compensating effect over 2 periods. So with this, I think I will conclude the session. Madhav, hope I have not taken too much of your time. We can